Hello, welcome to World Business Report. I'm Jamie Robertson. Well, bankers' bonuses back in the spotlight today after European regulators announced tough new rules to curb excessive risk-taking in the industry. Bankers will only receive 20% of their bonuses up front in cash, and the rest will either be deferred or held in shares for a minimum of 3 years. Now, these rules are much tougher than those agreed by the G20 countries, raising fears that bankers might immigrate to more lightly regulated countries. The bonus limits will apply to the entire global staff of European banks. Well, I'm joined by Chris Roebuck, who's a professor at Cass Business School. Did this come as a surprise, particularly the fact they were more tough than the G20 had agreed to?
It's not necessarily a surprise. Traditionally, the Europeans have been more interventionist in terms of the way they play banking and other industries. The Americans take a much more laissez-faire approach. So the fact that the Europeans are taking a tougher approach really isn't a surprise.
What about this idea that bankers may just go off to somewhere where the regulations are less tough, or at least where they can get better bonuses?
Certainly, that could well be an issue for some of the banking community, and that as these come in, every individual top-performing banker is going to be looking at the figures and saying, if I move to X, Y, or Z, I'm going to effectively end up with X $1,000 in my pocket more than I have now, and that will be a personal decision. The key question is about what the banks do themselves vis-à-vis how they make their profits.
Because we know that HSBC and Standard Chartered, which both have very large operations in Asia and also in Africa, they've pointed out that there could be a real problem there.
Definitely. If we look at the global banking market, without any doubt at all, the biggest emerging market is Asia. Both HSBC and Standard Chartered are making a lot of money out there. And the key question is, if they are forced to pay their staff in the same way as they do in Europe, in a market where it's not traditional to pay like that, and their competitors are more in line with paying cash up front, that could be a problem.
But this is to stop excessive risk-taking. The kind of people who want that kind of money now on the table, as it were, which is the kind of money, let us suppose, a Chinese bank would offer them instead of working for HSB or Standard Chartered. Are they the kind of people we really want in our banking industry? I say ours, but in a European, steady-state, responsible banking industry.
In general terms, we need high performers, wherever they come from. And as far as the regulation is concerned, the risk control should be happening in the organisation itself. It is a global market for these people, and let's face it, any individual who's given the choice, do you want the cash up front or do you want to wait for 3 years, all of us would go for the cash up front.
Do you think high bonuses did cause a lot of the problems of the last 3 years?
In terms of what really caused the problems, I would say bonuses were a small element to it. There were all sorts of other factors involved in A, setting up the problem, and B, tipping it over the edge. For example, mortgages in the USA. Washington Mutual, as we heard from the Goldman Sachs questioning by the Senate committee, 80% of those mortgages were verbal-only assurances about people's income. If you're doing business like that, you're effectively taking a risk. And it was those things that tipped it over, not really bonuses.
These are just guidelines at the moment, but they are guidelines to the regulators throughout the different European countries to toughen up. Will all the different countries in Europe do the same thing, or will they just vary the way in which some will be less tough, some will be more so?
In general terms, I think it's down to how much they think they have to conform exactly to the guidelines. And the guidelines do give a fair amount of flexibility. Having said that also, let's be fair, it's about how big a financial services industry you have. And as far as Europe is concerned, without doubt, the biggest financial services industry is in this country. So because it's having a bigger impact on us, we have to look at this much more carefully in terms of the real commercial impact on our banks and the real impact on our tax revenues.
OK, Chris Roebuck, thanks very much indeed for that.